Welcome to the WT3 Podcast. This is the Venture Capital Insights episode. We are focusing today on how to raise capital, attract investors, and demonstrate wise capital utilization, also when to raise. Today with us, we have Jason Fang. Thank you for joining us, Jason.
Thanks for having me.
A trailblazer in your space in the blockchain realm, co-founder of Sora Ventures, Asia's pioneering cryptocurrency-backed venture capital firm. Under your leadership since 2018, when just a year after I started in the space, Sora has invested in key blockchain ventures, including Mithril and AlphaSlot, raising 30 million in assets. No mean feat. You started your blockchain journey in 2016 at Fenbushi Capital. You played a crucial role in bridging the Ethereum Foundation with the Chinese community. Beyond this, your investment success, you mentor emerging tech talents at the Alchemist Accelerator and Startup Bootcamp. As the CEO of Sora Foundation, Jason drives blockchain community development and education, also serving on the Blockchain Institute Chicago's board. We feel that you really embody the spirit of innovation in blockchain and setting the stage. I mean, we just talked about your schedule. You're flying, speaking, and then back in the space of a month. It's just incredible. I mean, how did you get started in this space? Like, what was the catalyst for you to jump in 2018?
Yeah, no, I first of all, appreciate you guys for having me here. A big part of the industry in general is a lot of the early days people who got involved. So I got involved in 2015, and the way I got involved, similar to a lot of other investors, is they had some kind of like dev or engineering background. So I was doing full stack iOS just before I joined Fenbushi Capital, and I also had a finance degree, which is quite unique. I basically usually anyone who goes the finance degree route, you usually go straight into banking, and then several years of banking, go straight into MBA, and then after MBA you do private equity, like a very standard route. But I ended up doing like basically startups in college, and I ended up learning how to code. Ended up doing a lot of that after I graduated, and that gave me the opportunity to really understand how blockchain as a whole functions. So I knew Bitcoin as early as 2012, but I didn't start trading it until I really realized kind of like the benefit, the value that blockchain is kind of like. At that time, it was still early. It was basically mostly Bitcoin blockchain. But when I joined the industry and started investing on a professional level, there are some applications of Ethereum blockchain, and there's some kind of documentation in terms of what Ethereum blockchain could do. And so you really do need to have a lot of these, dev background in order to start kind of understand why is it even meaningful? What does it mean to be fully decentralized? Like, how do blockchain like visually look like? Like, how does the logic look like? Why is it unique? Right. There's a lot of these details that without the dev background or the engineering background, it'll be really, really hard to get involved with this space. There's really two types of people in our space. Like one, are mostly traders and speculators, and there's one who are more on the dev side or more on the tech side, or genuinely believe in the tech. I like to say I'm more of the latter, which is more into the tech side. And so when I got recruited to Fenbushi Capital, like was one of their early employees there, was in charge of the U.S. market, which at that time, like 90% of the deals at Fenbushi was coming from the U.S. So I played a relatively crucial role in terms of building their first set of portfolios in at Fenbushi. When you did that, you kind of realize that it's like, there are certain industry that works really, really well with blockchain. There's certain industry that don't work really, really well with blockchain because of just how conservative the industry is. And so when I started Sora Ventures, like one of the things I did was, I really aimed for, in my opinion, the low-hanging fruit. At that time, we call it entertainment. And entertainment, referring to, in today's world, is really just GameFi, NFTs, metaverse, social fi, a lot of these terms. But back then it was they're basically non-existent, right? We just call them entertainment. So it was 60% of our fund investment in entertainment. Some did really well, some didn't do so well. But the part of venture investment is it's always the larger wins. This one deal that gives you 100x that kind of covers a lot of the losses, right? And that's how venture business works. So in this kind of like environment today, like we're looking more on, we have several funds, but fund one was mostly entertainment, which was 2018, early 2018, and our second fund now is which we launched early last year. That is on something called Ordinals, which is basically Bitcoin utility. And that is something that we started investing when no one was investing, and that's really kind of our thesis here. We're not only investing in early stage startup, but also investing in early stage narratives. And generally in our industry, you're really trying to bet on these early stage narrative because the idea here is the industry moved really, really fast, right? Like Bitcoin utility today is one of the hottest topics around Web3. But when we first started investing, it was like people were doubting on us. Like people were saying, "Is this going to be a real thing?" Historically, everything that had innovation around Bitcoin ended up going to zero, or it led to a bunch of wars between miners. So all in all, it was all negative feedback. But regardless, I think there is some credit to building a fund that from 2018 and still alive. It probably means that it's not purely just luck, right? I mean, luck plays a huge part, and I'm more than happy to share some of the stories that I've been through. But I think ultimately there is that element where it's like there's skills involved, there's experience involved, there's a visionary part involved, there's an understanding of the technology involved, there's an understanding of the user, the industry, the dev, all that involved. There's a lot of components, but a Web3, in my opinion, is one of the hardest, most difficult industries in the world because, whereas like in private equity, you're trained to really just focus on one industry. Like for example, you have, you're in PE, you're going to be in real estate, then you specialize in PE real estate. You'll do relatively well. In Web3, it's like if you're in Web3, you got to know everything. You got to know marketing, you got to know the secondary market, you got to know primary market, you got to know market making, you got to know tokenomics, you got to know marketing, you got to know community development, you got to know the Chinese ecosystem, you got to know the English, the Western education, Western ecosystem, and the culturally very, very different. And so like, it's not something that anyone can pick up easily. And that for that reason, like there's a lot of volatility in this industry because in the world of trading is about like how much it's a difference in knowledge. And Web3 is one that's been amplified at a whole new level, right? And so, which means that it's early, it's very, very volatility, but it also means there's an opportunity to make money, right? And so this is what we're trying to do is we're trying to identify things that generally people don't see, and then over the course of several months, the industry pop or the narrative pop, and that's when we capture a lot of that alpha. So that is basically my business.
It's very interesting, Jason, because in a sense, like what you're doing is de-risking in very like you de-risk it by getting information, and in a sense, we're sitting in a similar business. Obviously, like we're doing tech. Charlie is doing like biz ops and marketing. We're doing the same thing. We're getting as much information upfront of a project in order to de-risk it as it grows, so we get the most success out of it. The client gets most of it, and it's not that different from your perspective, except like you're going on a potentially risky early narrative where the payoff can be huge, but you're de-risking it by getting as much information and perspective as you can in order to make it a success, right?
Yeah, I think it's a bit of both, right? So, for example, like when we look into entertainment, this was like again early 2018. Our industry was going through a phase of something called ICO, initial currency offering, to something called STO.
I was there, man. I was there.
Yeah, exactly, right? That was
those were the times,
right? And then there was a correction in the ICO, and then a lot of people were saying, "What's the next big thing?" And some people were saying it's the STOs, the security token offering.
Yes.
Especially in Asia, that was like the biggest thing after ICO. Like all the VCs were betting on STOs. Everyone was like, "This is going to be the next big thing," right? It's like it makes a lot of sense, right? If you think about it, it's like blockchain was always meant to kind of disrupt the traditional finance, and so like when they saw like it was disrupting something, and then now it went to traditional finance, and that STO narrative made a lot of sense, right? But being in Fubushi and worked in and seeing a lot of things, even at that time, it was only like 3 years. It did feel like it was like 5-6 years. I've seen a lot, right, in the sense that I have a pretty good understanding of what is a backward step, what is a forward step, right? And The one thing we did not touch was STO. Where everyone was talking about STO, we were looking at something called NFTs. At the time, it was called 721s, like ERC 721s. And we were looking into gaming of 721s. Like at that time, it was really very much like on-chain gaming. There was not a lot of volume. In fact, at the time, a lot of our investors were saying like, hey, why are you investing in NFT? Like it's literally less liquid on NFT, like OpenSea, compared to like the STO market. Like you should be going for STOs. I'm like, no, I feel like STO, in my opinion, is like a step backwards. I don't think that actually makes a lot of sense, right? At least not now, right? But worked at Fenbushi, and there was like a lot of investments that we did. We had to do with fintech, with blockchain. It was a blockchain element with a finance element, and it was like it didn't work out because it was a struggle, right? It wasn't just the fact that you need to be a really good entrepreneur and being able to sell your product and be really good at innovating product. It was also the fact that your customers were willing to take this risk, right? And the world of finance is incredibly conservative, and it's incredibly hard to penetrate because there's all these rules that are set up already, right? So it's like really, really difficult, and eventually STO didn't work out, but then the NFT part worked out really well for us. Just to give you like some idea of like how diversify our NFT portfolios that we did was, it wasn't just gaming, because we didn't know what NFT was going to be, right? We knew NFT itself was going to be innovation, but we didn't know like if NFT was going to be like just pure gaming. So we invested in things like NFT emojis, like NFT.
Oh, really?
Yeah,
that's great.
The most random thing, right? Every emoji is an NFT.
Yeah.
And you can put a string of emojis together, and that's one NFTs. And then we invested in companies that did like NFT for artists, and then we did like NFT at decentralized peer-to-peer network using NFTs. A bunch of stuff, right? So and gaming, of course, gaming, and it's like it became very obvious, like like at one point after a couple of years, that okay, NFT was gearing towards more of the GameFi stuff, like a lot of the gaming stuff, metaverse stuff, right? But initially, like no one like knew what NFT was going to be, right? It was all this memes that was happening, and so like fast forward to today and last year, when we looked into Bitcoin, we also had some like understanding that this would be big, because Bitcoin had a value add, which is you could, if you move any NFT from Ethereum to Bitcoin, in that case we call them ordinals, then every digital art on Bitcoin will hold all the properties of a blockchain. Whereas like if you any NFTs and previously, it's all basically stored in either a centralized server or a decentralized server like IPFS, right? So it's like it's a string. It's basically a string talking like that leads to the asset, right? So it's like it's half baked, right? And so when we saw ordinals, it's like at least some digital art side, we're like, hey, this is quite interesting, right? And then slowly after a couple of months, there was the discovery of the BRC20, which is like an enabling basically the fungible token of Bitcoin assets. And then after that, it blew up. It got listed on Binance, and the rest is just basically a lot of new innovation around Bitcoin layer 1. A lot of people going to Bitcoin layer 2. There's a lot of this stuff happening, right? So our fund went from 25% as a mandate to invest in Bitcoin just a year ago, to now telling our investors like, hey, we're going to invest 7% of our asset into Bitcoin, because we've built the momentum. We feel that the industry is mature enough for us to be investing in that category. But the most important part is that a lot of the audience in the Bitcoin world today kind of recognized as one of the leaders in being very, very upfront about our value investing, about what we like about Bitcoin, what we don't like about Bitcoin, why we like it, why we don't like it. So it's not just like, hey, we invest in the entire ecosystem around Bitcoin, but we're also very, very picky about what we invest and why we're very picky about that. So like, it's important as fund manager, you're not only just FOMOing because people are excited about stuff, but you also have to be rational. You also have to be logical, right? You also have to be not short-sighted, right? You gotta be visionary in terms of like, you're betting on this because you feel that there's going to be value created on the Bitcoin blockchain. So like, these are things that we feel very, very strongly as a fund manager.
Well, I mean, this is what we're hoping to sort of harness some of that visionary piece for our listeners, for our viewers, to essentially say, like, what is it you're looking for? What was you going to say, Thomas?
No, I was saying like it's a thin line you're walking. I can imagine. I mean, and to your point, like I think our listeners like hear this probably, they're like, holy shit, Jason is probably a superhero. But what I mean by that, because it's a very thin line. You got to do, like as you said before, you need to know everything about everything, making the right decision at the right time. I can imagine that there's a lot of stress involved, and you're not always making the right decisions, right? Like I assume that there's moments that you're like, shit, I could have done this differently.
Yeah.
Or
yeah,
I actually the FOMO'd in when people like when this started happening. Like and the other way, I think, I went in and this is where I lost capital. Right? I think I assume there's those moments too. That's the dark side of the superhero, I guess.
we were very. I guess our fund is not big, right? Our fund 2 is only 50 million, which is like small compared to a lot of larger funds in the US. But there's benefit for being a small fund. Small funds also mean that you're capturing early narrative. You're looking for things that have, 50x return, 100x return. Whereas larger funds, they don't really care too much about the 100x return. They want, for example, you invest in 10 million USD into a deal. If it flipped 2x, it's still 10 million, right?
Yeah.
But for us, when we invest, we're putting in like 250K, 500K check size. At most, we're probably putting 3 million into a deal. We're expecting like a 10x return, right? So even a 10x at 3 million is only 30 million. Which is, it's comparable to, like it's different product means that you have different strategies. But for us, because we're small, it also means that we got to be very smart about like where we capture alpha. And when we did our fund, it was 25% Bitcoin and 25% decentralized science, which is another thing that is like relatively new. I'm not sure if you heard of it. The short term is called DeSci. But the narrative is that it came out from the Ethereum Foundation. Vitalik is actually one of the guys who really has been pushing DeSci. We managed to invest in one of the second company from Brian Armstrong, which is basically focused on DeSci. The idea of DeSci is basically leveraging a lot of the Ethereum applications that have been built in the past, like NFTs, DeFi, DAOs, and then applying that into the world of science and research. And that was a narrative that we were extremely excited about. But out of these two narratives, it was very obvious that we captured a majority of our wins and momentum on Bitcoin. And then quickly decided to like, okay, well, if this is the case, then we should probably pivot mostly on Bitcoin because it makes a lot of sense, right? If you found momentum, you found the pace and you found your position in the industry, you just go for it, right? Whereas most people say, hey, you shouldn't put everything in one basket. I'll probably say like Web3 is one of those things that you're already in considered to be a high risk product. And if you look at the history of Web3 bull market, they always capture one narrative. It doesn't capture most of it. If Bitcoin price goes up, everything will go up, right? But there's always this one specific category that always like gets 100x return. Like for example, the early days of ICO, right? 100x like crazy. The early days of DeFi, right? 100x like crazy. The early days of NFTs, 100x like crazy. You meant to like the early days NFTs, right? Like 4A, you've been retired right now, right? So it's like a lot of these things that in our industry is like it's always targeting this one new narrative, and it's never the same narrative twice. And so like when we looked at this, we're like, okay, well, we've picked up a lot of momentum on Bitcoin. Let's double down on Bitcoin, right? And DeSci might come in later, but at least like for this current product, fund 2, we think it makes a lot of sense to be investing in Bitcoin ordinals, and then maybe from fund 3 we'll double down more on DeSci. Like these are some of the strategies I think a lot of fund managers when they start, it's like, okay, the mandate is 25, 25, 25, 25. But for us, it's like when we realize that there's something that's bigger than that, we should definitely pivot and then should kind of like focus on one thing that actually makes sense.
It's a product market fit for the fund, like very, very specific. I find
very specific for sure.
Yeah, and I mean that's probably also why it works like it works, right? At least for Sora. So and that's great. I mean, we in our podcast talk a lot about product market fit over different industries, and it's one of those things that are always very important for most of our guests. Found it, right? Like you as well. Like, okay, what are key factors for startups that you're looking at for product market fit? Like how can they validate their product market fit in these markets and in these narratives, right? Because as you said, like every bull, the narrative is different, and I don't think that every startup should follow a bull narrative because obviously they want to grow past the bull. But how do you look at and how do you validate product market fit with these startups that you're looking at to invest, for instance?
Yeah. So, if you're a Web2 entrepreneur, like a lot of times your product market fit comes from the user experience, from the user base, right? You want to grow your user base. But actually in Web3, you don't need to actually grow your user base. You want to grow your community and token holders, which is very different from the users. The users are the people who use your product. The token holders are the people who want to speculate your product, right? And so again, the best way to look at this is, in any market in Web3, you should always be focusing on the community first and then product second. And people will probably argue like differently, which is like, especially in Web2. If you come from a Web2 perspective, you're always like, product is number one and the marketing is number two. In Web3, it's very, very different. In Web3, because all the 100x, 1000x projects that actually do well, it's not because they built a really good product. It's because they've raised so much money. They have a lot of cash in hand, and they're listed on Binance. They're listed on OKX. They're listed on all the top exchanges. They have so much money to burn. They're able to pivot and find that product market fit later on. So majority, actually, I'll probably argue like 99% of our investments have all been through that phase where it's like, if you actually did well and you're able to build something today, it's not because you decide to do that on day one. It's always because you pivoted halfway in, and then because you list on Binance, you have so much cash now, then you focus on building products that actually make sense. If you actually just raise money to build product, majority of the time you're kind of screwed because you'll realize it's like no, you build this product, but like no one knows about you, right? You build this one product, but like no one's using you guys. Like there's so much distraction that's happening in our space. There's so much like many things happening in our space. Like people have opportunity costs, right? Most people in our industry, even today, are not here for utility. They're here for the speculation. Like I think the ratio, I think Vitalik a couple of years ago, like just 5 years ago, he will probably say it's like utility is like 1%, 99% is speculation. Now I think it's definitely like utility has grown up a lot, but even those utility are driving forces to speculate. So it's like, DeFi, for example, it's like they're using the DeFi products, but it's like to make money, right? Gaming products, yes, they use the product, but it's there to make money, right? The to earn model, it's like they're, like StepN, they're running, but then they're running to make money, right? It's like everything that we do is ultimately boils down to making money. And so fundamentally, that means like in Web3, it's always going to be speculation. It's always going to be your token holders that comes number one, and then your utility that comes number two, right? So that's a logic that's like fundamentally very different from like Web2 versus Web3. And people don't understand that. You have a lot of Web2 entrepreneurs who come into the space are not degen enough. They don't understand this concept. They raise a bunch of money. They end up building this product, and then they spend zero on marketing. They spend zero on community development. They spend zero on like talking to the community, and they spend zero on even identifying, picking up on what's hot in the marketing in the market. Then a lot of times they're basically screwed. So it's important for us to even invest in entrepreneurs who are sharp in the space, who understand the space, and when the time comes, they pivot. Right? Some of the best deals that we've done in our space are not the ones who start off with like doing this one thing and then they end up actually doing the one thing. Even Binance, for example, like when Binance came out to do their ICO, they, the CC came out on stage and they were pitching, like telling people like what Binance is going to be, what BNB is going to be. Like half of the stuff that they've done in the BNB is like has totally irrelevant to what's happening in today, right? Totally irrelevant. Right? The only thing that's actually made sense was the exchange business, right? Similarly with most of our investments, like some of them started as doing like peer-to-peer real estate and then end up doing peer-to-peer artists, and it was the NFT boom that basically made 30-50x for them, right? So it's like a lot of these things that we realize is that like, investing in the team is way more important than investing in the product. And that is something that's like fundamentally very different from Web2 and Web3. And so when you're looking for a product market fit, you shouldn't be looking from a user perspective. A user is also important, right? But, majority of the product, again, majority of product in this industry is all driven by your token holders. Like how many token holders you have, how big your community. If you have a larger community, then a lot of times it means you're also listed on top exchanges. Exchanges want these community to be trading your token, and only then can you convert a portion of that into your product, which end up being a lot of utility. Of course, there are exceptions to that statement, which is like, for example,
I was going to ask Jason, just to dip in here, what would you say are the key KPIs that you're looking for? Like if they've got XYZ, like they've got great in Web2 terms, great cost per acquisition, great conversion rate on the website, you're happy to put more ad spend in essence. Like, what are the KPIs you're looking for product market fit? Like, if you see that green light, what's the next thing?
To be honest, there's a lot of there's a lot of like fake data in our industry that is like pretty easy to produce.
Yeah.
So I generally feel that in the Web2 world, like KPIs is actually a really important metric, right? Like you, for example, you go to YC, they will always ask for like, at least you need to have like, the 100K or 10K user base, right? So you got to hit a certain amount of users in order to even get money from, accelerators. But the whole idea here is, in Web3 it's totally different. It's totally different because you can spend money to get users. For example, you can just buy users, you can buy followers, you can buy engagement. You can also buy users in the sense that you create a earning model. For example, like STEPN, right? You get people to run, you get people to do something, they earn the token, and then in the process, like you create users. Like, is that a KPI that you think is worth, because they hit like 100K or 500K downloads? Is that something that you think is worth investing? In my opinion, in the Web3 world, a lot of people say yes. Sorry, in the Web2 world, a lot of people will say yes, but in the Web3 world, it really depends, right? So, whereas I love to answer a question where it's like, are there specific metrics for KPI? I'll probably say that it's probably more of other things like, is it what narrative are you in, right? Like, if, for example, if you're in the Bitcoin narrative today, you're incredibly hot and probably going to get a lot of money from investors. Whereas if you're like, if you're in the let's say something that's not hot today's market, like STO, like you want to do like an STO today in today's market, you're unlikely going to get any users, even though if you have KPIs, right? Even though you have like really good KPIs, you're unlikely to get any user base. And the reason for that is because you're betting into something that is not hot. And this is actually quite similar in the Web2 space as well, which is like, Web2 money is a lot slower. It's a lot easier to predict. For example, like in 2011, it was kind of the ed tech era, right? So like, people, if you did ed tech in 2011, you could have easily gotten money from Silicon Valley. And then nowadays it's like AI, right? It's healthcare, it's Web3, right? It's like there's always a trend, and the larger that narrative, the longer it takes, right? But in Web3, it's like really, really fast. It's like a Web2 narrative, but everything on steroids. So it's like everything is a lot faster, like 4 times more faster. So, if you go for one narrative that's hot, you probably have like, 1 or 2 years to really fundraise. So the idea here is, I think going for the right narrative is more important than going for the right KPIs. Now, once you hit that, narrative, then it really depends on like who your investors are, how legit your team is, how, like I said, like how many holders you have, like how big your community is. Yes, some of them will always have some fake elements, to it. Most of them will probably have like fake element to it, but our industry is like mostly about like fake it until you make it. A big part of that is that's our industry. And so yes, it is why it's very hard as a VC to be making money in this industry for most VC, right? There's only going to be a handful of really good VCs that will end up making money for their investors. A majority of the VCs don't even make money, right? So for example, we have friends who are running funds. Majority of the funds are not that great as an investment. And so we try to be the outlier, right? So if what we've learned is like, if your friends, if all the larger funds are not making money, then by copying them, you're most likely not going to make money as well. So it's very important for us to like innovate, and like as a fund, it's like, tell your investors, it's like, yeah, we're not a generalist fund. Like, so if you invest in us, it's like, you're not going to have exposure to a bit of everything, right? Because all the other funds out there is a bit of everything, and the end result is that they're not doing so great, right? So, but if we're a special niche product where it's like, if you want Bitcoin exposure, that's us. If you don't want Bitcoin exposure, that's not us, right? There's hundreds of funds out there that you can invest. You don't have to invest in us, right? So,
but interesting because
yeah,
you're like looking at competitive analysis for your fund. I mean, when you're looking at an investment, what do you focus on when you're evaluating a competitive landscape for a Web3 project? Is when you're looking at that, do you say, okay, you're a new entrant into a space that's been around for 4 years? There are some incumbents, but they're bigger and slower. However, they've got a bigger community and a following. Like, how do you sort of evaluate that landscape when you're looking at a Web3 project?
Yeah. I I think the most important thing here is, regardless of what you're investing, there needs to be, again, you don't want to be investing when the market is FOMOing, is like incredibly hot. Well, most people will be like, hey, it's hot, that's why I want to invest. As a VC fund, we do the opposite, right? So it's like when if things are like, for example, like the last bull market, while everyone was investing, we were exiting. And then when people were like struggling and like figuring out like, oh shit, like it's Bitcoin going to 12K and 9K, that's when we start investing. That's when we start actually investing, right? Because during the bear market, a lot of the entrepreneurs will have, like, the real entrepreneurs will come out, and the market will naturally filter these entrepreneurs. And so you're an entrepreneur raising in the bear market, it shows you have balls, right? And like that, in our opinion, is already like a competitive edge. People will not agree. Like, people will be like, "Hey, you shouldn't fundraise in the bear market." I can tell you that if you fundraise in the bear market in Web3, it means you have balls, and a lot of investors really like that. At least I will invest more aggressively in the bear market because of that, right? Especially in the bull market. The bull market, I'm very conservative in the bull market. And in bull market, it's like whenever everyone is investing, I'm doing post management service, and when it's peak, I exit. Right. So it's like, we always do the opposite, right? And when people are not investing in that cat narrative, like no one's investing in Bitcoin, we're investing in Bitcoin, right? When people are not investing in like entertainment, they like went for STOs, we're investing in entertainment, right? So again, I'm not saying that you should do things that the opposite, right? When people are selling, you should buy. But there is a lot of logic to why, like, the things that we invest, right? I can be, and that all has to do with timing. So whereas again, Web2, there's a very, very clear framework to, like, what are some of your KPIs, what are some competitive edges. In Web2, in Web3, because, you know, a lot of times it has to do with timing, it has to do with narrative. It has to do with your resources, but resources can be filled in quite easily with the right investors. Like, for example, we invested in what we call Bitcoin Layer 1, right? One of them is called Tap Protocol. Because of us, like, you know, we've basically got them to integrate with a lot of exchanges. We've brought in really good communities to build on top of their ecosystem, because we have gotten a lot of, you know, value add that we can add in the ecosystem, right? And these are people we've worked with a long time, and these are resources that we know could add value to both parties. And so a part of my job is allocating a lot of these resources among each other. So, for example, we have 30 plus portfolio companies in the Bitcoin Layer 1 space. A lot of them will actually end up working together. And if they don't end up working together, we can make the intro, and they end up talking to each other, and then they end up doing something together, right? So that's a benefit, where it's like, even though as a company by itself, it doesn't have like a lot of competitive edge, but just because you're working with the right investors, you're able to kind of fill in the gap for a lot of these things. And that is quite also unique in our space.
So how important is team in that matter? Because, like, you know, when we talk about competitive analysis, like,
team is number two. Team is number two. Yeah.
So because team composition is, from our side, like, when we start a project, when it comes to development, right? Like, we're a development consultancy. What we look first is like, hey, is this team actually capable of okay, we can build it with them or for them, but are they actually capable of understanding what needs to be built, how it needs to be built, how they need to envision the next steps, right? Like, for us, having a good CTO or having a very good non-tech CEO that understands what he doesn't know is really important for us, because that's where we say, okay, we measure that. When it comes to success, that's a big measurement for us from a development side. But, you know, I'm very curious about your pieces when it comes to team composition, in projects that you're looking at, the companies that you're investing in. Like you say, it's number two. What are the things that you are looking at in a team, and what kind of competences you're looking at for different roles, maybe even?
So team is number two, because I think timing is number one. If you have the strongest team ever, but the market is going down nonstop, Bitcoin's going down, everyone's going to crash. Like, your altcoin will crash as well. Like, that's just like the fact, right? So it's like,
unfortunately,
unfortunately, right? Some of the best teams are, like I said, right, the sharpest people who are they have some, they're like in the 30s, 40s, ideally the 30s. 30s are usually the best in my opinion, because they've already seen, they're not like as new and green as a lot of the early entrepreneurs. Like they've done several startups before, the start companies before, so they have a very good fundamental understanding of like building companies. And they're also like, that also has a technical or engineering background, so that maybe they don't code anymore, but then they have a very good understanding of the technology, of the innovation around blockchain. That's really, really important, because some of the best CEOs, I would probably say, if they're very, very technical, usually they're also like, the world's fair. Like if they're very technical, then it also means that you're not very BD focused. You don't have a very strong business sense, right? The world is so fair in that sense. It's just like very, very technical, like they suck at BD. You're really, really good at BD, you suck at tech, right?
Yep.
Yeah. So some of the best, entrepreneurs is about finding the middle ground. Like the CEO, you gotta be good at both, right? You're not extremely expert, like you're not specialized on either side, but then you understand both of them. Like, so in my opinion, that's like the best. And then you have a CTO who's just like all the way to like the technical side, right? Who doesn't even need to meet any of your investors, right? And then
he comes out of the basement every now and then to say hi. It's like, milestone 1 is done. Okay, back.
He goes offline for 3 days and he comes back to and be like, hey, I'm back, guys. I got this new update. Like, yeah, let's do something about it and let's test it out, right? It's like, like that in my opinion is the best. And then of course I think the CEO, in my opinion, needs to have really good experience in terms of working with third parties. So like for exchanges, investors. I mean, one of the most important parties in our industry is the exchanges. The exchanges, unfortunately, they're like the most important component in our industry. And so like if you get exchanges to like you, then they'll list you. But if not, then that is going to be a lot harder, a lot more work for the investors. The other part that we're seeing like very interesting right now is like the exchanges also like to find like to basically work with entrepreneurs who are flexible. In a sense, flexible referring to like, they might want to like, hey, can we adjust some of your tokenomics? Can we adjust some of your vestings? You might have CEOs is like very, very firm and like very like does not want to be flexible. Like there's a lot of CEOs are like that, right? Like they're like, hey, we can't do that. We could then they lose the opportunity, right? I mean, exchanges they have hundreds of deals, thousands of deals each day. They don't have to list you. They can list anything. They'll probably be a win for them anyways, right? So it's like then you just be left alone. So it's also important to invest in entrepreneurs and CEOs who are flexible and they're willing to work with things like what's out there, utilizing your resources and your opportunity. Like that's really important. Like part of being sharp is part of understanding that there's opportunity to be captured, and that opportunity might be your next 100x. And those who see it versus those who just ignore it, huge difference.
Yeah. Okay. Yeah.
In terms of Web3, obviously, this is why both myself and Thomas are in the space. It's like an incredibly fast industry.
Yeah.
In the early stages, so we're talking the kind of checks that you cut. What is it that Web3 startups in the early stages have to have in their pitch text for you to be interested, but also to demonstrate that growth and scalability potential to investors like yourself?
Yeah.
And to add to that, like, are there any sort of milestones that indicate traction that you're looking for, where you're like, this is interesting?
I think there's obviously in Web 2 and Web 3 are very, very different. In Web 2, I'll probably say like somewhere around like 100K to start, or some people will, depending on the accelerator, right? But generally you want 100K users. But in Web 3, because the onboarding process is a lot more complex, it also depends on what you're doing. For example, if you're doing a 10K NFT project, you're looking like 10K within a 10K NFT project, you're generally looking at around like 4,000 to 5,000. That's like the sweet spot. So you have like 4,000 to 5,000 users, right? If you're looking at like more of like a product, like a general Web3 product that has fungible tokens, the address you usually want is somewhere between like 10K to 20K ideally. Some will have Some might have, like 4K, 5K because they're listed, and all the tokens are all like all the holders all put put their tokens in one address. Like for example, exchange address, then it will show like 4K, 5K. But if like realistically there was like no exchanges at all, and they're all kind of like separated and all distributed, then you're looking at somewhere like 10K to 20K. Yeah, that's like the level where you can start talking to like VCs in general.
So that's starting point.
That's a starting point, right? That's a starting point.
Yeah.
If you have like a couple hundred,
if you
have a couple hundred, it's not good enough. Yeah.
Okay. If you've raised already, let's say you've raised like $500,000 to $1 million, and then you're on your way to, hopefully in Web2 terms, becoming a scale up. What kind of traction are you looking for then?
Yeah. So you're in a raise already. Actually, to be honest, is like most of these numbers won't even show up until like you actually complete all the raise, because the whole idea of Web3 is that you raise a bunch of money, your token is not listed yet, so your token is not even distributed yet, right? So there's not going to be a metric where it's like like let's see how many token holders you guys have first, and then we'll pitch in or put in the money, right? It's usually the other way around first, whereas it's like you raise the money first, and then you get the token distribution, once like we call it TGE, right? Token generation event. Yeah. So realistically, that's the number for that we're referring to when I mean by 10K to 20K. It's really realistically when you're talking to like exchanges, right? It's like you start talking to exchanges, then they're like, hey, how many addresses you want? I mean, from an exchange perspective, they always want more. That like the more the merrier, right? So some of them will have you like, if you hit like the 100K mark, then you're like really, really good. If you hit like the 500K mark, like 500K address, that's like really, really, really good, right? So it's like these are like some of the metrics, but like to entry, it's like like probably like 10K to 20K, right? Like from a VC perspective, it's slightly different. Like I said, like from a VC perspective, we look at other metrics, right? We look at things like the team, the tokenomics. Like tokenomics is really important too. It's like tokenomics is one is like your understanding of the narrative in the industry, like where we're at. Like for example, you don't want to be giving your tokens to your investors during a bear market. You give your tokens to the bear market, you're gonna get pretty wrecked, right?
And it happens. It does happen. Like
it happens all the time. It happens all the time, right? In 2018, like everyone, like the investors got all their tokens in like mid 2018, like 2019. They all got wrecked, right?
Learn that lesson hard way.
Yeah, exactly. So you asked me like what are some of the metrics and how can we tell that if this entrepreneur is experienced or not? You look at the tokenomics, right? You look at tokenomics. They're able to identify like what's a good time to be giving investors. Investors eventually will have to exit. It's either now or like later down the road. You might as well pick the time that it's like the market is full, right? So like these are things that it's incredibly important for us as investors to identify if this is worth investing or not. The second time like things are like your investing. How long is investing, right? And if your narrative is about launching, like your narrative is
of the tokens versus your equity piece, or when you actually put money in,
Yeah. So these are all things that we look at from a metric perspective. Like other things, like I said, with users, followers, some people come up to me and be like, hey, Jason, we're incredibly interested in, working with you guys. And look, our Twitter account has 200K followers. When I look at it, I could immediately know that there are a lot of the Twitters are bots, or like they're bot. Like they went with a third party platform that is just pumping followers in, or they're getting people. There's like events going on, they're doing giveaway like nonstop, and so like there's people engaging on it. But is that a good metric? I mean, like if you're pitching to like Web3 investors who just got into this space, they're new to this space, they'll be like, oh man, this is amazing, like we should totally invest, right? But and I've been in this space long enough, so I know like this is not like something that could get me excited, because if I want to do that, I could do the same. I could hire a third party company and a marketing company, and this is what I pay them to do. I don't know, I'll give them 10K every month or 20K every month, and their job is just to make sure that my account is growing and getting a lot of engagement whatever I post. So it'll be a 10x of whatever it's out there, right? Like versus like if we didn't use the marketing company. And they only need to do this for like maybe 5 months or 6 months, because in this period of time, they're using that golden period to fundraise. So a lot of investors fall for that. It's like, this is why I feel like I don't necessarily suggest founders, spending too much money on it. It'll work. It'll work sometimes. Like, depends on who you're talking, like the type of investors you're talking to too, right? But people will do it regardless. And I think for most project, if everyone's doing it, you can speak. I don't suggest pumping too much money into this. But I think put in as like a small amount so that it's not like zero, right? I would probably say like a Twitter account generally that I look at, the amount that I like is somewhere about like 10K to 20K, 30K, and in my opinion, a 20K to like 80K, there's not much of a difference. And I could easily just spend like 5 minutes scrolling through a lot of stuff from, and I can have a pretty good, like if you look at the comments too, you have a pretty good understanding. And then you click on the users, right? The quality of users, just you do like a couple of times, and you immediately know if these are real or not, right? You immediately know. So spend some money on marketing, but don't do it, like don't overkill it. If you overkill it, then the VCs who do know what's up, right? They'll be like, why are you doing this? Like, are you trying to scam my money or something like that? You're making it too intentional, right? And that actually raised a red flag, right? So
quality over quantity for that point, right?
Oh, for sure, for sure.
How significant is this is the last piece on traction metrics, really. Like, how significant, if you're evaluating a company, and then percentage wise, just for practicality, so how significant is user adoption versus that community engagement piece? So like, we've got 20,000 people on our Disco, 15,000 people on our Twitter, we've got 5 to 10K users, versus partnerships. So we're teed up to work with, say, Polygon or someone like this. When you're looking at a company, how important, and it's really essentially defining where our founders, our viewers should spend their time. Is it going to conferences and trying to drum up partnerships? Is it really diving into the community and answering every single question they have on your product? Or is it trying to build your social proof? Yeah.
So my word of advice is always fundraise, spend the money so that you get listed on a good exchange. Don't spend all your money on building products, because building product is I mean, there's a saying is that you're never done. You'll never be done coding, right? You'll never be done like building. If you're a developer by background, you're always like, there's always improvement. There's always things that can be built on top of your existing code base. So there's like a never ending job basically. And so if you just keep spending money, you can basically code for 10 years, like nonstop, until you basically run out of money, right? So you shouldn't be spending like 100% of your time. I would probably argue not even like 70% of your budget into coding and into building product. I think you should spending a fair good amount of time so that you get the attention of the community, attention of the audience, attention of the exchanges. I think that's important in our space, specifically in Web3, right? And the idea here is like, why do I think there's no point of overkilling and putting your Twitter account 200K? Because it's just you do it too much, then people will understand that you're just here. You're very short term, right? You're just
shilling your token. Yeah.
It's too obvious. So you want to find that balance, and I think that balance is usually like 20K, 30K. I think that's pretty good. If you do over that, then it just means your BD is like 80% or 90%, which in my opinion means that you're never going to build a product. And once you get listed, you're going to dump your own token, and then we're going to get wrecked. Like, our investors are going to get wrecked. Right?
So that transition is really nice.
You ask me like, what is some of the best teams and best entrepreneurs I looked at? It's like, it's definitely not the 100% BD team. It's definitely not the 100% tech team. It's like a balance, right? Yep. And the same thing, you can kind of identify that through just how they engage and build their Twitter account. Yeah, so it's really interesting. It's like, people don't realize that. It's like your Twitter account, the way you build it, is a really good. It's a really, really good. I guess it's kind of like a foreshadow of how you want to build your token and your when you get listed after TGE, because if you're really strong on BD, then you're definitely going to have a lot of shilling. You're going to have a lot of partnerships, but even these partnerships can be really shady. Like, remember the early days in 2017 and 2016. It's like a big connect, right? I want to say like there's like the early days of Ethereum, right? It's like there was the Chinese Ethereum, there was Japanese Ethereum. You remember the Chinese Ethereum was like it was Neo and QSub, right?
Neo. And shares, right? That was like
and shares,
oh
right?
my god! Oh man, I was early there.
And then it was so early.
I lost my shirt on Neo. I did. I aped on Neo, and that took a little bit off the back. That did.
that was the funniest thing ever. It's Neo was like they made an announcement.
It looks so good on paper.
It did look good. It's really smart. I mean, like the people who were like shilling in Neo, it's insane, right?
Yeah.
They said they said like Neo was working on the Chinese government or something like that.
Yes, that was the narrative. Yes. Didn't it skyrocket to like $80 or $90 at some point? Because I know at some point I got out. Like, but
it went to 150.
150, yeah.
So I jumped at 70 because there was that announcement Jason just mentioned, and it went to like 150, and then it just tanked to like 17. But this is a great transition to the next question, and I'm going to push the narrative along because I'm mindful of everyone's time. So in terms of a fundraising strategy, so we're gearing here to try and give our viewers as much value as possible, like try and demystify this industry for them. Can you share some insights on like an effective fundraising strategy? Like, when is it optimal to raise funds? What should they aim to achieve before even thinking about trying to talk to someone like yourself, like initiating a funding round? Like, what's the way around this? Like, what's the best, slickest way you've seen someone just coming into the room and just being like, okay, we've done all this stuff. You're like, shut up, take my money.
And this might be a very hot question because at least from the clients that I've been working with, we hear this very, very often. Like, how do we like raise like strategically the best, right? And they're asking a development consultancy. I'm like, well, you should probably talk to somebody who knows more about this. So this is a really like a hot piece that we definitely now with, I think, a bull or coming bull. I think that's a piece where people really would like to know this.
On YouTube, Arch, I think we're going to get out here.
Yeah, no. I mean, that's a great question. I think the answer is I kind of break down into three parts, right? It's first of all, is the timing part, which is like in any fundraising, it all boils down to timing of like, like if the bull market, then obviously you fundraise. If the bear market, then you obviously try to avoid fundraise. But that's why I say like I really. But then there's also the argument, which is like. Like I mentioned, I really like entrepreneurs who are fundraising during the bear market because it shows they have balls, right? But again, this is like for the general public. This is like for the average Joe, right? If they just want to fundraise, like definitely fundraise in the bull market. This is majority, like you remember like FTX did fundraise in the bear market, but then of course like FTX is like the next level, right? And so like they don't care about if it's bull market or bear market. They just do whatever they think it's right because they have a lot of substance, right? But most entrepreneurs in this space will not have that level of substance to begin with. And so generally the idea here is, and you will see that trend very, very, very obvious, which is during the bull market, some of the very mediocre entrepreneurs will come in and start fundraising like crazy. That the timing is important. The second part is the narrative, right? Which is, for example, like I said, right now Bitcoin is hot. Like, so Bitcoin people are doing Bitcoin layer 2, Bitcoin layer 1. Like these are some of the hottest thing in the industry. Like some of the layer 2s are worth like, $1 billion valuation before even listing, right? Restaking is hot. All that stuff is hot because there's the added layer and the narrative that people can benchmark against. And so like there's always going to be money that your people are going to be chasing because the narrative is hot. And so that's really important. It's like, even if you don't end up doing something that is within this narrative, start with that narrative and then pivot later. Right.
Money in. Right.
Yes, exactly. And the third part here, which I think is really important, is that when you're talking to when you're talking to a lot of exchanges, always make sure that there's a room for you guys to give some advantage to the exchanges. Exchanges, regardless, I'll be very honest. It's like, regardless, if you're talking to them early or you're talking to them late, at the end of the day, if you end up listing on the top exchanges, they're gonna take a slice out of it. They're gonna take some shady ass deal out of it. Like you know what I'm saying, right? It's like you might as well just allocate X amount of that early so that you can give exchanges that early discount or whatever they want, right? So
and it's always I to that point. I think it's always, at least from what I've seen, it's always a bigger chunk than you think it will be.
100%, right? 100%. Like,
that is a very important thing to mention, because people are like, oh yeah, no, it's like $500,000. It's like, well, that might be more. It might also be less. It depends on the exchange. It depends on, but it's always more than you think. So allocate more and reserve more than you think, right?
Yes. So these are kind of the 3 points that I think it's important when it comes to fundraising. Is like you always have to allocate a bit more than you want, because exchanges might want some discount. And if they're not going to get discount from the venture side, they're going to get discount when you list on the exchange. So at the end of the day, you're still going to give exchanges that benefit. It's just like a thing in our industry, right? A lot of people are very stubborn about it. They don't want to do that, but it's like, man, if you don't do that, then it's like other people will just not work with you. So you might as well just be prepared to give out a bit more to exchanges rather than investors, like regular investors.
I mean, this topic segues perfectly into the next question, which has been asked by our viewers, is basically your tokenomics. Like, how important at the front end when you're raising are your tokenomics, the utility of the tokens in the valuation of Web3 projects? What are some of the common pitfalls? Like, if you see a tokenomics model and it causes a red flag and it causes everyone to run for the hills, like, what are those things that people should avoid? How can we add value to the space and say, like, guys, just this is at least the direction of travel you want to be traveling in when you're thinking about tokenomics? And then further, like, how do you evaluate those models? Like, do you actually go deep into the numbers? Is it, this makes sense, I've seen this before? I mean, I know certainly when I was working in finance, it was, this makes sense, we've seen this before, but I'm going to throw analysts at it and make sure, right? In Web3, because of the pace, I just don't think that's feasible every single time. So there's got to be some general trends where you're like, okay, here's a marker that shows this person's thought about it. They know what they're talking about. They have at least some business sense in terms of being able to put together a spreadsheet that actually functions. Like, what are you looking for in that?
Yeah, no, great question. So there's no fixed framework around tokenomics. Tokenomics is actually the third most important on my list. So, like I said, timing's number one. The timing also kind of slash narrative. That's number one. 2 is the team, and the third is tokenomics. And you'll be surprised. Actually, the last one is actually product. Product is the least important. Yeah,
it's important.
Well, it makes sense in this list, honestly, because if you have a great product but the rest is garbage, then it doesn't matter how great your product is, because actually your product will be garbage. There's no scalability to it.
That's what we say.
We've invested.
Like, you could have the best product in the world, but if it's come out at the wrong time and nobody knows about it,
doesn't matter.
It's just a great product that no one uses.
Yeah. I mean, I think the point here is, a lot of people think a product is important, but it is important. But I think the point here is, do not be discouraged if your product is not popular. And do not be discouraged if there's no users using your product. That's the point. So in that sense, like, product is not important in the sense that if your people are not using your product, then you can always pivot and you can do something else, right? That's the point here, and which is very common in Web3. But going back to your question about tokenomics, I think there's a couple of things that I think we look at when it talks about like tokenomics. Like, one is, like I've mentioned before, like, are they actually offering clear tokenomics when we invest? Because a lot of projects don't even have tokenomics when we invest. And this is also a very common thing in our industry, which is like they're doing an equity plus token warrant raise, and then they just don't have the tokenomics figured out. The question is, in what situation is that acceptable? And in my opinion, anything with a valuation lower than 30 mil.
That's interesting.
Interesting.
Yeah.
Okay.
Okay.
And this is post seed. So they've already
this is
raised
like
a bit,
the first. This is like the first round or first 1.5 round, like anything below 30 million. And again, anything below 30 million, because right now, if you look at majority of things that's happening right now in our industry, everything starts at like 70 million, 80 million, 100 million. So again, I'm referring to this current time. I mean, obviously, if the bear market, then we might be going for like anything below 50 million, right? Every different times call for different metrics, right? But the whole point here is referring to the benchmark in today's world. Then anything below 30 million, we can accept with no tokenomics. Because in our opinion, it just means that they're early. And by when you're early to a point that you don't have tokenomics, having tokenomics actually puts you in a spot where you'll be stuck. Because the whole point of tokenomics is that you want to be as close, your tokenomics should be as close as to TGE as possible. If you're designing a tokenomic that does not work with the time you launch, that's going to be an issue.
Yep.
And that's basically the risk here, right? So a lot of people have like tokenomics, and then they launch within a year, and then they realize it's like, shit, like that doesn't even work out. So they end up changing tokenomics. And we've seen that a lot in the past, right?
Yeah.
Or they just go for it, and then investors get wrecked. We've also seen a lot of that in the past, right? So the idea here is, from an entrepreneur perspective, is like it's okay to not have tokenomics if you're super, super early. But okay, so the question now is, when should you have tokenomics, right?
Yeah.
So I think anything above 30 million, 50 million, you should have tokenomics.
Valuation.
Yes, exactly. You should have very clear understanding of when do you TGE. You should have like how many, if you have any cliff, do you have any, like what's your vesting, what's your lockup, what's your distribution? It's a monthly basis, daily base. How do you achieve all this? Like, is it done through airdrop, or does the user have to mint it? If they mint it, if they don't mint it, does it stake automatically? Like stuff like that, right?
And would that also include like the utility economics behind like the token, like how it's being used in the platform, all these kind of things? Like, you want to see that too. Yes, right.
So that part of the utility in terms of the tokenomics, we usually leave it out until even closer to TGE. Yeah. So the way it works is like you always figure out the distribution for investors first. And then once you have that, then, I mean, usually it's like, there's like for example, you'll have like a portion for investors, you have a portion for community, you have a portion for the actual product. The actual product side, like we will work with them after we invest. Like a lot of times they don't even have too much clarity on how that works. And so
it's also really, I think really hard to and challenging to build a good utility tokenomics, at least from like the people that we've worked with. There's not many people out there that can actually do it. You need to have a finance background. You need to understand how, let's say, today's world works, both in Web2 and Web3, depending on where you're launching it, right?
Utility token is by far one of the hardest things to do. That's why people love meme tokens.
Oh, right? Yes.
Meme coins are the best, right? Because you have no roadmap, you have nothing, you have no expectation. There's only upside. There's
pure
no
speculation.
Pure speculation.
So Jason, to that point, because like I think that there's two things here that are really important. Like one is tokenomics. I think the other part is utility. And then I think people sometimes mix that up, right? And I know I've done it in the past as well. And I think it's really important to look at tokenomics, like as you said, before TGE, and then the utility of the tokenomics comes kind of after. Yeah, but I think the hardest, like, how do you ensure that scales? Because so if we're looking at like, so far we're talking a lot about timing and narrative, right? And every time there is a different narrative, every, let's say 3-4 years, there's a different bull, different narrative, right? Having tokenomics scaling towards that narrative or towards what is important or where it's going to be important is really hard. So at some point you will need to diverge from the narrative and the timing, where you say, okay, well, but this is our utility. This is our perspective that we believe in is going to be doing well for our users, etc. It's like there's a critical point. And I think it's a really hard point to find, right? As somebody,
not really. Like I think a lot of people find it hard because they're not able to drop the Web2 mindset. So like I said, if you build a product while figuring out like building your token market cap and everything, it's gonna be tough. It's gonna be really tough. But if you just focus on one thing, and then once you get listed, and then you focus on building, like integrating a product into your token, you'll be a lot better, like so much better. Like I'll give you an example, right? So, we invested in this project, and then initially when they were looking to launch a token, they wanted to do gaming, and then and that was like initially the gaming element, and then after a while they realized like, gaming is not a large enough narrative to get money, so then they have to build on, they want to build like a layer 2,
Right.
like their own, basically their own blockchain, right? And then where you can scale a lot of the gaming products on top of it, right? And so it like that of itself, like again, if you same topic, which is token utility, but if you apply the gaming token into if you apply the token into that actual game, there's no way like there will be worth billions today, right?
Yep.
Same, exact same thing, same team, same token utility is if they actually apply that token into the entire network, because people can build on top of that network, then the token becomes like a mega city, right? And it becomes much more valuable. The narrative expands. And so in this situation, no, we've told them like, hey, look, it's actually okay to not have utility in your token because you haven't found your product fit yet. So just focus on building that narrative first. Like focus on building like, the market cap if you need to. Focus on building a narrative first. And then after you build a narrative, then focus on launching the biggest narrative for your token, right? Which is, in my opinion, is your own blockchain, right? And that's what we've seen in this industry, which is like if you are able to build your own blockchain, like that's why I'm so bullish on Bitcoin Layer 1, because all the Bitcoin Layer 1s are essentially the Solana, the Near, the Avalanche, everything on Bitcoin, right? Whereas like these side chains they're basically competing with a lot of shitcoin tokens, blockchains, right? Which you need so much money. Like you need so much money to compete with each other. You're basically like an EVM, and like your own EVM, and you have to build everything from scratch. But if you're building on Bitcoin narrative, it's like it's non-existent. It's like it's a low-hanging fruit. Like it's entirely new. And it's like basically the old, like the early days of Ethereum, right? There's Ethereum, and there's a bunch of like protocols out there. Like you're basically in a market where it's like you have a benchmark, and then there's all these stuff that's happening under that, and so Bitcoin Layer 2 is competitive because you're basically competing with like all the Ethereum like blockchains out there, which is a market that's been around for like since 2017, right? But Bitcoin Layer 1 is entirely new. It's like it's just like we just discovered Ethereum, and now let's try to do something like let's do a fork of Ethereum and then do something new. It's like, so again, reproducing the Avalanche, reproducing the Near, reproducing the Solana, reproducing the things that have occurred today into this industry, but benchmarking on something, which is in this case we're benchmarking to Bitcoin.
So to that example, I think that's really interesting. So let's say the narrative is chosen, the timing is set. Like in this case, blockchain bull. Tokenomics is set up. We have now raised. Where should those proceeds go? Right? Like, what is the use of all that cash that we just raised? Like, let's say that valuation is above 30 million, so we have great utility. Where are we going to go? We don't have a product yet, right? Like, how do we distribute those proceeds? Where are we are strategically throwing money at? We already talked a little bit about it. You said like product last. So how does that look from a percentage perspective? Is it marketing 60%? What is your perspective on this?
Yeah, it depends on the market. If it's like bull market, I'll probably say spend a bit more on our marketing. If it's bear market, I'll probably say spend zero on marketing.
That's like zero, completely not. Where does that money go then? Does it go to product or?
Any marketing you do during a bear market, it's going to be completely wasted. Completely wasted. I tend
to agree, but where does that money go then? So let's say I think we have that's two good examples, right? So let's maybe start with the bear market. So bear market, no marketing. So where does the money, like we raised in a bear market successfully, which is crazy, we're super happy. Yeah. What are we gonna do now? Not spending it on marketing. That's one.
Yeah. So if there's two ways to do it, right? If you're in the bear market, you should be spending your money either in R&D or product development.
And by R&D, what do you mean by R&D?
Like R&D as opposed to like for example, a lot of companies are like spending their money on building infrastructure or researching around infrastructure, right? So not necessarily spending all the money on developing the infrastructure, but spending the money to research and to figure out what the narrative. So more building like the decks, like the content, like the white paper, the stuff that you can, like the bull market comes, then you can like show this to investors and raise a bunch of money, right? So like that type of stuff is much more, in my opinion, much more important. Like their R&Ds, right? Than the product development. But if you already have a product, then you can obviously innovate on top of your product, right? Like for example, like during the FTX, FTX actually did build a really incredible product that solved a lot of, the funds issues with the OTC and all that stuff, right? So it's like, then you can innovate on that. But again, the whole point here is they were smart about it too, because during the bear market, they were also spending some time on R&D, and they decided to launch FTT, right? Same thing with some of our portfolio companies that did really, really well. It's like they were investing a lot of R&D into pivoting, into figuring out how to utilize NFTs, and so they spent a lot of time building content. And then when the bull market came, they pitched it to new investors, they pitched it to new partners, and people loved it, and it went like 30x. So it's like these are some of the most under like I guess a lot of people don't usually do, but I think it's incredibly important. Like, even for us, like as a fund, like when we're during the bull market, obviously we're quite active, but during the bear market, we're spending a lot of money and time into R&D preparing for the bull market, for the next bull market. Right.
So,
and then
sorry, go ahead.
And then that ultimately led to our decision to invest in Oranos and DeSci.
So Bear, spend your money on research, do a lot of R&D, less product, no marketing, clear. So now the bull, right? So we raised a ton of money in the bull. Everybody's happy. Everybody throws money at everything. Where are we going to spend our money? Is it now marketing?
It is mostly marketing, yes. Marketing, product, just enough products so that the exchanges, like you guys have the capability and the tech and enough capacity to actually build something. Like there's something that's really interesting about this industry. It's like there's like there's like a lot of scam, like there's a lot of scam and there's a lot of memes, right? And the way I define a scam is like you tell people you can do this, but you can't actually do it. And there's a meme is like you just tell people there's like you'll never achieve this. You'll never have a roadmap. You'll never have any utility. And it's people are perfectly fine with it. And in my opinion, it's like memes are not scams, right? I think it's the utility tokens are mostly scams, right? It's like they tell you that they'll draw a picture. It's like, and again, like the early days of ICO, right? It's like you're basically selling a dish before the restaurant is even built, and at the end of the day, the customers will never even taste that dish, right?
Well, so to that point, the memes are very transparent. Nothing will come out of it, and if you're okay with that, you know exactly what's going to happen, right? That's I think the call it the value of the meme tokens.
Yes, but to answer your question, I think in the bull market, you're definitely spending a lot more money on marketing for the exchanges to get listed. Spending a lot of building community so that people get excited about your product. Right. Because again, like product, you can have like the worst product ever, and you can still get a bunch of users involved because there's like a to-earn like framework or model involved, right? And that's like the unique part of our industry, which is like people generally accept doing like things that are stupid and boring, but then at the end of the day, if they make money, they'll do it.
Yeah. This is very true, and it sometimes makes my product heart bleed a little bit. I'm like, guys, there's such a nice product. It's like, no, we're degenerates because we can earn something from this.
Yeah.
So I'm going to dip in here and rapid fire the last 3 of the 10 portion, because there's just been so much good stuff coming out that I haven't wanted to interrupt and shove us along. But really the meat and where I'm really excited to get to is the brainstorming component. So I'm just going to rapid fire these, bullet point them back at me, and we'll jump into the brainstorming piece.
What is the question regarding the
so there's 3. So the investor value add beyond the capital, what's a green flag for entrepreneurs when you're looking at an investor or an advisor for a Web3 startup? what are generally like the bullet points, the criteria as green flags for an investor?
Yeah, so I think a good way to look at it is, obviously there's branding component. There a lot of investors are also generally quite equipped with the knowledge to build tokenomics. A lot of investors, that's like the general kind of like, that's just general skill set, right? They'll be like, hey, take our money because we have good brand. We can help you with tokenomics. We can basically be the consultant or the advisor without actually, taking additional tokens or USD. And so we're like, we're the expert in finance and tokenomics, right? And even fundraising, right? It's all that stuff. But beyond that, it's definitely the investors that can provide a lot of community, like real organic growth in your product. And I'll give you an example. So we invest in, again, like in a lot of Bitcoin layer ones. Like part of our job is to get a lot of good developers, a lot of good projects built on top of that chain, not that protocol, in order for the community to see that just alpha going on, right? There's like, you're basically building alpha for the retailers, for the community, right? That's important. I think that's important because if there's no alpha on the protocol, then people are not gonna want to build. It's like a chicken and egg thing, right? It's like you got to have community users or followers first before you're able to kind of track like more developers into the ecosystem. So that's what we do a lot. We try to, not just from a project perspective, but more from an ecosystem perspective. Like and Bitcoin layer 1 is so early right now. Like we don't even care if you're just building on BRC20 or TAP or runes or rings or whatever, right? As long as you're building on Bitcoin layer 1 is a win for Sora Ventures. And so the way that we do it is we've hosted a conference. So, last year we did a conference called Sora Summit in Taipei, end of the year. And this year, we're bringing it back again, 2 days. We're flying in DJs. We're expecting more than 100 speakers just on the Bitcoin side. It will most likely be the largest Ornos conference in the world. And so if you guys ever want something crazy where it's like everything Ornos and you can get runestone and stone everywhere, like that is the conference to attend. It's going to be end of year. So like these are things that for a fact that like it's tangible, right? This is there, right? It's like
real.
It's real. And so like when an investor is able to do something like that, it not only shows that they're willing and able to bring in a lot of the resources for you, but more importantly, it's like they understand that they're not like this one individual who just are here just to make money, but you also care about the ecosystem. And that is very important because every investment firm, almost every investment firm in our industry in Web3, they're all called a VC. Everyone's called a VC. But it takes a very specific trait, like a very positive, like a very unique trait and character to be a true VC. Like for example, in the traditional finance, in the world of finance, there's VCs, there's PEs, and hedge funds, right? Hedge funds they look at numbers, right? PEs, they look at numbers, right? They look at a lot of tractions, they look at a lot of things. Like VCs is by far the ones who generally don't look at numbers the most out of the three, right? But in our industry, there are going to be VCs who only care about paper money, who doesn't even care about if you're going to make it or not. They just want to get the paper money, the 5x, 10x on paper. And from their perspective, they're okay with, investing in higher valuations because they're able to get a 2x return, but it's going to be like a 10 million return, right? And there's going to be VCs like us who cares more about like the 100x return, the 50x return, right? And then but then they're all called VCs, right? That's a funny thing. We're both VCs, but then they have entirely different business models, right? And there's also VCs who are just like, we're just here to pump and dump, right? And there's like a lot of that, right? And there's also VCs who are like, during the bull market, they're like, we're investing in everything, and then spray and pray, right? And then during the bear market, they're like, we're not even here, right? They're also called VCs, right? So it's like, there's so many types of different investment firms out there. They're called VCs, but entrepreneurs do not realize like these VCs are not actual real VCs. Like most of these VCs are just here to make money. And so in order to be a real VC, you got to be a giver. You got to be a very genuine giver where you believe, because the VC model is in order for you to make $1, your portfolio company will most likely have to make $100.
Mm-hmm.
Right. So you're only getting a small amount of profit based on the overall success of your portfolio company.
Yep.
Like that's how the VC model works. All right. In what business does it require like anyone to be like, hey, you make it 100x for your portfolio company and only get like 1%, right? So you have to be a true giver. You have to be a true giver. You really like genuinely you enjoy watching people succeed. And as a process, you make a bit of money. It's sustainable, but like that's how the VC model works. Not a lot of people are like that in our industry.
Absolutely no. I mean, this is one of the first times I hear the narrative of how I personally look at VCs so well explained by somebody in the industry, because it's very often the other way around, right? Like,
for sure. Sure.
That's the biggest. I always joke with Charlie and with some of my friends that are in the same industry. Is like, VCs are necessary evil, but they aren't if you're a true giver, because now they become support, now they become help, right? But very often they're necessary evil because you need their money, but they will not add any value, or they steer you actually in the wrong way.
Especially in Web3,
especially Web3, yes.
Especially in Web3, yeah. I tell my friends who are in this industry, they look at us as like, oh, you guys make a lot of money. I'm like, you guys don't know like how complicated and how complex and how shady this industry is, even after so many years, right?
Yep.
It's 99% scammers, regardless of your project or VC, and you're 1% the giver.
Yep, there's a lot of takers in this space.
A lot of takers, 99% takers, right?
A lot of
Some are takers, like extremely called scammers, but generally they're 99% takers, 1% giver. Yeah, and so it's really, really hard to look for VCs who are genuine about what they do, who are genuine about growing ecosystem, who actually enjoy watching people grow more than themselves.
Yeah,
very hard.
No, totally.
Makes my, by the way, sorry to say this, Charlie, and then I'll leave it to you, but that makes my heart, as again, development, super happy to hear this, that there are people out there that do this, right? Because that is something that, I've seen my clients, past and present and future clients, somehow getting rugged by their VC. And it's just really nice to hear that there's just people out there like you, like Sora, that says, well, screw that, we're not like that. We're actually the complete opposite. And the whole stigma regarding our particular piece in the industry called VCs is really bad, and we are aware of that, and we're actually looking to change that, because that's kind of what you're saying here, and I think that's beautiful. So that makes my heart like really happy here. Charlie, sorry.
No worries. So question 9, post-investment expectations. So what are the post-investment expectations? Like, what do you want to see? You've just put in a ticket, 250K, 500K into a business. What do you want to see? Is it reporting, governance, strategic involvement in the startup? What's your expectation?
I think it's important that it depends on what stage the company is in, right? But like from our side, after they're done with fundraising, so Sora Ventures have a bunch of media companies that we invested. So for example, we're investors of Bitcoin Magazine. We're investors of Wu Blockchain, which is the biggest like media company in Asia. We're investors of Crypto Slave. We're investors and we were investors in The Block. A bunch of these media companies. We have about 7 portfolio companies in the media space, and generally we don't make money from the media companies. So it's equity, and if you're in the media business, you'll know very well. It's like it doesn't go 100x. It doesn't even go 10x, right? It's like you make some money and you're able to sustain for this business for a long time. Generally, when you invest in media, you're never going to get any form of returns. And so it's never like a great business to invest, but we do it anyways and we're probably one of the few funds ever in the industry that does that, where we can invest some money into media, but because we feel that media is one of those businesses that is so important, so important for the industry. And you should be backing them because they play a very important role in the industry, in the sense that they're the ones who are providing a lot of news, they're providing a lot of education, a lot of content for people who are new to this industry, and they're like the bridge where like people are just starting to learn about something and they want to get in, right? This is important for us. So this is why it's important. And the second part is, we also want to be working quite closely with the ones that we have a lot of trust, like high trust, where, for example, like we're not going to if we don't believe that this project is legit, then we're not going to obviously share it with our media portfolio company. But generally, when we do share it with them, they will always announce it, and they'll always announce it in advance. So like these are value add, I think, where we'll also help our portfolio company get more exposure, right? So these are some of the things that we do for portfolio companies. So it's like, if you get money from Sora Ventures, you actually don't end up spending that much money, or you don't even need to spend that much money on media and exposure, because we can do that for you for free. And that's kind of like our perk. Again, going back to being a giver, like this is like the most immediate giving opportunity, where I think a lot of funds will might be like, hey, we can do this for you, but we'll want this, we'll want this leverage. But for us, it's almost a guarantee. If you take money from us, we'll do a lot of media exposure for us, for you guys, regardless. It's just depending on like the distribution and level of the quality of media platforms. But from the project's perspective, it's like, once you have some media exposure out about the round, it's all, usually it goes to the questions like, do you want to do another round? Do you want to do a follow-up round, right? Again, depends on the stage, but generally when we invest, it's like we're investing in the pre-seed and they're kind of round 1, round 2, and so there's always going to be a follow-up round, and that's the question. It's like they raise just enough money so that they can raise more money in the following round, right? And then once we raise in following round, it's usually about like getting listed and working with exchanges, and so this is where we start making some intros to them about like working with like larger funds or exchanges, and you can start talking to them, right? And then if exchanges are interested, then they generally invest. They end up working with them, but regardless, they're on the radar, right? And that's really important, because like they can start tracking like the growth of this project. They start knowing like it's not like obviously there's always 0 to 1 experience, like this growth, basically you want to have exposure so that they know what's going on, and so it's important that from the project perspective, they're always giving like updates to exchanges, and these are something that we expect them to do. But on the product perspective, of course, I think they gotta have some upgrades, right? You can have no product before you even launch your if you do your first round, you can almost have no products, or have like an MVP, right? But once you finish a round, you should, at least in the next round, you should have some products that actually make sense, so that users are trying it. There's ways where you can use it. Is value add to a community, and like all that makes sense, right? So they got to spend much more time in between kind of like the first round and the second round to be building a product. And then once you hit the second round, you finish the second round closing, that's when you scale your product, right? You try to scale your product if it works. So a lot of times in the process, there's always these opportunities for retailers to get involved. Like again, we like to invest in layer ones. So like in between, there's all these like developers or other projects that are building on this layer 1, and there's always this alpha that's happening, right? And and then the portfolio company that we're working with are either supporting them in the process, and then while basically sharing alpha in the sense that, hey, whatever you guys built on top of us, like this is going to be the first phase of utility, and then once we do an upgrade on the protocol, then there's going to be more alpha being built on top of these existing utilities. So like these are things that could get people excited and to learn more, and then they'll get their friends to join, they'll get their other communities to join, and then they'll be able to expand. And these are things that we definitely feel that it's important, because you don't have to have like an amazing product. Like in Bitcoin, for example, it's insanely like I guess simple, because Bitcoin does not have a lot of the tools and the features just like Ethereum, right? So it's like even like just airdropping is like cheap airdrop on Bitcoin is like it's like a huge thing because one of the most problematic about Bitcoin is like the fees are incredibly high, right? And so it's like if you're able to airdrop to a lot of like users but for a relatively cheap price, like that is a feature people want, and that like if you can stake on your network on Bitcoin, that is a feature people want. But like staking on Ethereum is like incredibly simple, right? But it's like staking on EVM based stuff, it's incredibly simple. But it's like in Bitcoin's world, it's like that's incredibly hard. It's like unheard of, right? Nowadays, you want to stake, you're basically on a side chain that's built on EVM, so it's not effectively a Bitcoin layer 2. They call it Bitcoin layer 2, but it's effectively not Bitcoin at all. But like that's how like.
I mean, to that point, actually, I mean, you're not talking kind of like about long-term vision and impact, right? Because like we've been so far, we've talked a lot about like short-term, like or shorter term, but this is kind of like specifically when we're talking about Bitcoin, it's like building a staking mechanism, building an airdrop mechanism. Those are long lasting impact.
For sure.
So,
yeah.
I mean, from that perspective, like, how do you look at long-term vision and impact? Like, are you specifically, like, as a VC, or are you looking at these things? Because, like, we talked about narrative and timing, but some of these things are lasting, right? Like, and these having a lot of impact, both, I think, in the Web3 community, but also, I think, in onboarding end users, right? So, how do you look at, and then I think there's a piece to tokenomics as well, utility, that we discussed, like, scaling your utility over the years and over the narratives and over the timing, I think, is a really important thing as well. So how do you all tie that up and looking at a long-term vision of an impact of a startup? Like, how important is that for you, and I think for the industry, right?
Yeah, I think in terms of scaling of utility, it should only it will always be different, in the sense that when you first start, it's always going to end up being different after like 2 to 3 years, and that's totally normal, right? This is like, like I like to say, like, you're really just finding product market fit as you grow, as you build your product, and that's like a Web3 thing. It's like, it's like you're basically always you start raising when there's like nothing, and then as you go, you start to find product market fit. I think what's important here to note is that within this journey of building and look, envisioning what's going to be valuable, there's always going to be case studies in our industry where you can benchmark and learn from. Like, for example, like, you can look at Ethereum, you can look at like a lot of the existing EVMs and how they grew, and there's a lot of stuff that's happening within the EVM space that especially for even for Solana, for example. Like, if people ask us, like, what is the limitation for Solana? And I'll say the limitation of Solana is equally the same as the limitation of Ethereum. If there's no innovation on Ethereum, there's no innovation on Solana. If Solana will innovate as when Ethereum innovates as well. They claim to be a better version of Ethereum, but realistically, in terms of the core features, like staking, like a lot of these upgrades that's happening on EVM components, like, at the end of the day, they're just benchmarking Ethereum. So if there's innovation on Ethereum, there's innovation throughout the entire ecosystem. And so I think what's important, but then it's important, like, if you're building on Bitcoin, for example, then, like, there's so many things that on Bitcoin that is not even achievable today. Like, that narrative, it's maybe like 3, 4, or 5 years. And that's why we're so bullish on Bitcoin. It's like, Bitcoin is basically an embryo. It's like zero, like absolutely zero. And then, like, we're going back to 2008, like, probably go back to 2016, basically, on the Ethereum days. Like, so it's like, it's a long vision. Like, if you want to say, like, how long, I could probably say maybe 10 years, maybe 15 years is possible, right? And then, like,
that's a big bet to make as well, by the way.
Oh, for sure. I mean, the only bet I'll probably make today is Bitcoin. I mean, if Bitcoin goes down 50%, all your shitcoin is going to go down like 90%, right? So it's like, so it's like, we're investing into the future of Bitcoin because the future of Bitcoin secures the future of Web3, right? One of the things that a lot of people are concerned about is the halving, right? Every time there's a halving in Bitcoin, then there's always articles that says, like, miners are going to go out of business. There's going to be, Bitcoin will be less and less decentralized. And I mean, that's all bullshit now, because we're investing in Bitcoin utility. Because now there's ordinals, like, fees have gone up because of ordinals, right? I look at the on-chain data every day. Like, it's like, there's activity on Bitcoin, right? A lot more than people expect there are. So it's like, these are genuine data that can be scaled to secure kind of the entire Bitcoin network, which, mostly to secure kind of the profitability of miners, and then which will ultimately secure the profitability of, like, the entire Web3 industry.
This has just been fantastic, Jason. So thank you for taking the time. We're going to bypass the brainstorming piece, because I think we've basically done it in the 10 questions, and I'm mindful of time.
I would say this, Charlie. Like, I mean, Jason, I could talk for hours with you, because your perspective on all these things so far, some of these things have been eye-opening. I'm in this industry for the last 6 years as a builder and as project manager and BD, doing all these things, but talking to somebody that has such a, say, we call it a pure view of what investing means and being a VC means in this industry, I think for me, it's been incredibly enjoyable to listen.
It's been a real pleasure.
likewise, in the sense that I think it gives us the opportunity to see that there are VCs who are, in the past, when I started first investing, for Sora Ventures, I always feel like it's important to FOMO, right? You're always important to capture what's hot in the market. Nowadays, I've been in the industry for like 8 years, where I've been like invested. I've been running my company since 2018. Honestly, I've seen so much in this space, and sometimes it's like the most important thing you got to realize is like there's always 100x opportunity, like 100x opportunities in the Web3 market, and so that you should FOMO into something that you don't understand, right? So nowadays, like even we have like meetings with my colleague, and my colleagues will be knocking my door and be like, hey, we got to invest in this company. It's like, it's hot as hell. It's like, all these big firms are investing. I'm like, what's the valuation? And then within 5 minutes, I'll be like, this is not worth investing. Like, I understand that like this valuation is probably going to go up. I understand that this is backed by some of the top firms, some top exchanges, but in my experience of investing, it's never about chasing that ultimately gets you to win. It's never like that. In fact, I think that will lead to a dead end, because it means that you're not an independent thinker. You don't have your own thesis. You can get distracted easily. And one of the reasons why I live in Taiwan and why we moved to Taiwan over Singapore, and most majority of people, if you're in Asia, you move to Singapore, right?
Right.
It's because the same reason why Warren Buffett is not based in New York, distraction, right? When you have a lot of distraction, you can't think independently. When you have a lot of noises around you. I mean, news in general, you've been in the finance world long enough. News in general is one of the worst media out there. For people who read news, it means like all this news has been out for within people who are in this industry hours ago. And so when you're selling the news out there, it's secondary stuff, it's secondary data. You feed into the audience and they get wrecked, right? So news is one of the worst data, in my opinion, to go for if you're actually like genuine about getting involved with finance, right? So like that same way in crypto, like crypto is the same way. Like the news comes out for something, probably 10 hours ago, it's sort of been like the market already kind of took in already. A small amount of players already kind of like knew the news, and there's already insider trading already going on, right? So it's like it should not be like our initial, like if you're an investor, especially you want to be an independent thinker, and then to have your momentum, you have your own style. It's important to not get FOMO in. Nowadays, like we miss these opportunities of these, Bitcoin layer 2. We don't feel a thing. Like we're actually quite, and we see so much. Like we're so transparent. We know exactly what's going to happen. Even if it's a 10x for us, it's like, oh, that's nothing, because we can make a 10x on there. Like we can make 10x on Bitcoin layer 1, every week if we wanted to, right? So it's like it's like opportunities like that every week. So it's like at the end of the day, you want to have your own style in investing, just like as an entrepreneur, regardless if you're running a VC fund, regardless if you're starting a new company in Web3, regardless if you're ready to pivot into new narrative, you should have your own style.
Yeah, that's big. It's one of the reasons why Charlie and I are doing this podcast together.
Pretty much.
Same reason. Like carving your own road, carving your own style towards what we believe is right and what we believe is important, rather than what the whole market says and what is being echoed on conferences. And I think that is so important. And also, I think towards our listeners, towards our clients, having your own style and being a bit stubborn in believing in what you're doing is not a bad thing.
It's not.
It really gives you an edge. And the right people will see that too. I think that's a very important thing to mention as well, because I think, Jason, when you guys started, people were probably also like, oh, that you guys have a bunch of crazy ideas, right? But as you move forward, they also see the success because you carved your own path, and they're like, oh shit, yeah, that's real. How did you do it? Well, by being a bit stubborn and by carving your own path and being brave, I think, in the sense, right?
That's
Charlie.
Right.
I'm going to move on to the last segment of the pod. So this is called your Desert Island Essentials. Something we came up with, or I came up with, that basically says if you had no bags, you were starting again from scratch, beginning of your career, no bags, no black book of contacts, no reputation, what would be, but you keep the knowledge you have now, what would be the 5 things that you bring with you? Program, book, course, tooling, something practical that you can share with our listeners that they should probably do.
Yeah, I've heard of a version of that before. I think, like generally speaking, if I go bankrupt tomorrow, I can definitely make it back. I think as long as you keep the knowledge, you keep the experience, like you can just, the one thing I will need is give me my t-shirt, my underwear. Yeah, I'm quite genuine about that. You give me my clothes, then I think I'll make it back quite well. Yeah.
Okay, so but again, like we have four more pieces, so it's very clear. Your clothes, that's an important thing, and and to that point, I think everybody needs that, right?
Yeah, there's a couple of books I think if you're referring to like things I think are really, really good, and that at various different life, I guess, part of your station, different your entire life, it helps a lot. One of them is, I'm a big fan of actually modern philosophy. So one of them is The Prince by Niccolo Machiavelli.
Right.
Okay.
Yeah. And I read that book a couple of times. And I read it in high school. I read it like, philosophy is interesting because philosophy answers a lot of questions that a lot of people cannot usually give a response to. As you progress in the business world, there's mentors they can talk to, but even sometimes mentors cannot give you a lot of the advice or proper advice. And so you go to books, but then of all the categories in books, it's generally, I think, the most extreme case is religion. But, generally within religion, I think philosophy, especially modern philosophy, is a very practical approach to solving problems and perspective on life. And so a lot of problem solving and a lot of understanding of things that the book from The Prince talks about can be really applied to the business world a lot more than people expect. Yeah, it's like in the East there's like the Art of War, and in the West there's the Prince. Actually, the irony is he himself actually wrote in a book called The Art of War, which is exactly the same title, but it's published at a different time frame, different year. If you didn't know that, yeah.
So that's your number 2. What's your number 3? I'm not gonna make it as easy.
My laptop, my laptop. You got to give me a laptop, right? My laptop, my Wi-Fi, right? Unlimited satellite Wi-Fi. I think those are important, right? You got to be connected to the world, right? You got to be like, this is all about like making money. It's all about digital, everything is digital in today's world. Yeah. So you got to have laptop and all these things, communication, Wi-Fi. That's important. That's like, that counts as 2, right? Yeah. I say that because honestly, like I've asked myself this many times. Like I'm in this work, in this business where I consider myself to be like high risk. Like if I do end up going bankrupt one day, can I make it back? And I'll say yes. Yeah, I feel very comfortable that if you just give me my t-shirt and my underwear and my jeans, and I can easily make it back.
So yeah. I'll count it as 2 if you agree with me on environment, because you just mentioned, hey, we moved to Taipei instead of Singapore, and together with Wi-Fi, having a laptop. Well, but I mean, like, so no distractions, right? Yeah, like we so if we put you on a desert island with just Wi-Fi and an electricity outlet, Jason will be happy, right?
Yes.
No distractions.
Yeah, and it's every business person will have their own Bible, their version of the Bible, and that's, for me, is The Prince.
So then we have one more, man. The last
that's one. Hard. I mean, I don't want to say like places. I don't want to say things like how like a shelter or anything or water like that, because that would be the most boring response.
Yes.
Yeah, but if anything, I think. I guess it's really hard to do this with on an island, but like one of the things I've always thought about, like, the way I look at money is that money is really a tool that you're borrowing from society. And so, whatever money, like, let's say you go to your island, you make your money back. So what do you do with the money? Like, it's useless on an island. So I guess with or on an island or without the island, I've always thought about this is, at the end of the day, you don't need a lot of money in this life. And so whatever money I make, I do want to like donate away to other people in society and to make good use of it. Actually, I've started donating to high schools already, like institutions.
Wow.
And it's like part of that is because, my understanding of money to me is just like it's a temporary tool. When you die, there's like you're not going to be able to bring it with you. And if you have kids, if they're legit, you can provide them with the best education from around the environment. But if they're not legit, even if you give them a lot of money, they're just going to waste it. And if they're legit enough, they'll be able to make more than you can. And so you don't actually need a lot of money to start a family, to especially the have kids who are like really, really smart and very successful. In fact, some of the smartest people I think who entrepreneurs in the last 200 years came from like really like medium like basically like normal families, right? It used to be the fact that like a lot of rich comes from their family, and that was like the old generation, right? In Europe and in Asia, but even in Asia today, it's becoming less and less of a thing. And so my fifth item is that if there's a way that we can send that money out and distribute that money out, that would like ultimately there'll be use for existence. Like there'll be a meaningful purpose for making money.
That's
cool.
I will say this. I think I've never heard that from somebody who runs a VC like that take on money, and I love it. No, I think it's great. Like Jason, I come from
part of the VC is part of this job. Like VC is just giving money, right? And so if you make more money, you give more money away. Yeah.
But this whole episode has been about giving and supporting, which is I will say I've been very surprised because I would not have guessed that at the beginning of this episode, which I think is really cool.
You don't follow my Twitter then? You don't follow my Twitter?
No, I will need to. Man.
Yeah, If you follow my Twitter, like I like to give a lot of stuff away.
I'll subscribe as soon as we can.
Yeah.
So Jason, where can people find you? What would you ask? Like, what's your call to action?
Follow me on Twitter. I'm always active on Twitter. People can find me on Twitter all the time. I'm very open to DMs. If I'm not checking, it's probably because I'm on the plane or somewhere, like most likely on the plane, right? But generally, I'm always checking my Twitter. Yeah, my Twitter is just Jason Sora VC.
Got it.
Fantastic.
Yeah.
All right. Thank you very much for today's episode. I hope you guys got some value out of this. I mean, if you didn't, you're the problem. So.
I know I had.
Yeah, I know I did too. And with that, we'll see you on the next episode. Thanks very much.
Thank you. Goodbye.